This is Nightly Business Report with Bill Griffith and Sue Herrera.
Final push, a rally of more than 1% today on Wall Street, but it wasn't enough to keep most stocks out of the red as the first quarter comes to a close. So how should you position yourself for the second 3 months of this year?
The American stream. More and more Americans are cutting the cord. How many? We have some numbers, and they may surprise you.
And batter up, it's opening day for the teams and the fans, but also for the big business of America's favorite pastime. All that and more on Nightly Business Report for Thursday, March 29th.
And we do bid you good evening, everybody, and welcome. Believe it or not, we closed the books today on the month of March and the first quarter of 2018, and stocks went out with a very strong finish. The tech sector, which, as you know, had been showing signs of cracking recently, actually led the way higher today. Here are the final numbers for this Thursday. The Dow rose by 254 points, putting us back above 24,000. Intel actually helped out here, rising by 5% on the day. The Nasdaq climbed by 114, and the S&P added 35. Now, for the quarter, the Dow was the big loser, falling more than 2%, its worst quarter since 2015 in the summertime, and it snapped a 9-quarter win streak, as a matter of fact. It's the longest in 20 years. And even with tech's recent problems, that is not a misprint. The Nasdaq climbed by more than 2%. I triple-checked that, couldn't believe it. And the S&P was down 1.2% during the quarter.
And now on to the economy, where there was some strong data out today. Jobless claims fell last week to the lowest level since January of 1973. Personal income rose nearly 0.5% in February, the third straight increase, while spending rose marginally. And the University of Michigan's consumer sentiment reading last month hit its highest level since 2004.
Well, despite today's rally, stocks have struggled, of course, to stay above the lows so far this year, leading some to fear that the momentum may have stalled. Mike Santoli takes a look now at whether the market has moved past what he calls peak happiness.
Stocks are showing signs of finding their footing after 2 months of struggle. For now, the major indexes have held above their February low points, and most evidence indicates they're still in a correction. That's a drop of at least 10% from their high, but still within a long-term climb rather than entering a deep or lasting downturn. Still, even if the market starts making headway again towards its January high water mark, it is possible Wall Street has passed its moment of what some call peak happiness, for a while at least, and perhaps for this entire cycle. That is to say, several investment factors are likely near or past their best levels for this economic expansion and bull market, which began 9 years ago. Among them, equity valuation, market momentum, financial liquidity, and investor optimism. The market's price-to-earnings ratio raced higher in late 2017 and through January to reach 23.4. Well above the 5-year average of 18, it has since retreated below 20 again. Market momentum, the sheer speed and angle of advance, hit multi-year highs in January as well. At the same time, financial conditions achieved their easiest point in years, based on low interest rates, plentiful credit, and calm markets. And investor optimism reached a crescendo of excitement early this year, too, gauged by surveys and retail brokerage activity. But importantly, if these factors have all posted their best levels of this cycle, it doesn't necessarily mean the market itself has already peaked. Growing earnings in a new prolonged phase of the economic expansion can carry stocks higher still, even if the peak happiness point did occur in January. That's the way it happened in past bull markets of the 80s, 90s, and mid-2000s, and it's what the battle-scarred bulls are hoping for again right now. For Nightly Business Report, I'm Mike Santoli.
So as we look ahead to the next quarter, now might be a good time to reposition your portfolio. Joining us to talk about where your money will work best in the months ahead is Nancy Tengler, Chief Investment Officer at Heartland Financial. Welcome back, Nancy. Good to see you.
Thank you, Sue.
It's hard to believe that the quarter has come to a close. This year is moving swiftly, certainly. How do you feel about the upcoming quarter? What challenges are you looking at for this market?
Well, thank you for having me. I'm relieved that we made it through the first quarter relatively unscathed. We had hoped for some sort of pullback in January, and we got it for sure. Now we're looking forward at new levels to earnings, and earnings growth is expected to come in around 13% for the overall market. So we're looking for companies that are growing faster and raising their dividends quicker than the market.
Technology certainly has been a focus, Nancy. You're looking to some of those companies where they will benefit from spending. Who are they?
Thanks, Bill. So, yeah, we like the real technology companies. These would be companies like Microsoft, Cisco, Texas Instruments. You mentioned Intel earlier. It's one of our largest holdings. These are companies that receive the spend that corporate CEOs are putting in place. Optimism in corporate CEOs is high. CapEx grew at 6.5% fourth quarter, and we expect it to grow around 9% in 2018. So these companies will benefit for sure.
What are you getting rid of? What are you taking out of your portfolio, or what sectors, perhaps better said, do you think might not be a good bet for this new quarter?
So we have been out of electric utilities, Sue. We think they're too expensive at these levels. We've been trimming a number of the FANG names that we had owned. So Facebook and Google were the two that we owned, and we'd been trimming those in January and again recently before the recent decline. And then I would say just overvalued stocks in general. So when we get a nice run in a stock, we trim it back. That would be Apple in the last few months, as well as Microsoft, actually, though we still like it here. It just got way overvalued in our portfolios. So we're looking to replace those with stocks like Emerson Electric that are lower level price to earnings ratio, higher dividend growth.
Well, you mentioned that higher dividend growth. An awful lot of our viewers here on this program love that kind of growth. Where are you looking for the best dividends right now?
So technology is actually old technology, real technology, as I call it, Bill. That group has grows the dividend pretty quickly. Microsoft at 15, Texas Instruments and Cisco in the 20% range. We also like what we would call Amazon-proof retailers. So Home Depot has been raising the dividend in the 20% range. And then FedEx is a beneficiary of Amazon and online shopping. They've been growing the dividend above 30% in recent years. And Boeing, even though it had sold off, and particularly because it is sold off on trade worries, we are not concerned about the company, and they have been growing the dividend in the mid-20s. So we like all of those companies because the dividend growth shows management's confidence about future earnings growth.
Do you expect in this new quarter that the volatility that we have seen will continue, or do you think the market's calming down a little bit?
Oh, that's a great question, Sue. I think I've been in this business for over 30 years. This feels more normal to me than last year did. Mm-hmm. Volatility is not a bad thing if you're investing assets or investing money. So I would say it's probably going to slow down a little bit, particularly if earnings come in strong and the Fed behaves. But I think volatility is with us for the rest of this year. Midterm election year, usually very volatile.
Okay. Thank you, Nancy. Have a great
Thank
long
you both.
weekend. Nancy Tengler with Heartland Financial.
Who clearly started in the business when she was in junior high.
Absolutely.
President Trump is targeting taxes again. This time it is Amazon. The president took to Twitter this morning and renewed his claims that the online retailing giant does not pay taxes and reportedly wants to go after Amazon as a result. But is there really anything that the White House can do? Ylan Mui takes a look for us tonight.
President Trump taking aim at Amazon over taxes. In a tweet, the president claimed that Amazon pays little or no taxes and that the online giant puts other retailers out of business. It's not the first time the administration has gone after the company. The tough talk started on the campaign trail.
If I become president, oh, do they have problems? They're going to have such problems.
And just last month, Treasury Secretary Steven Mnuchin doubled down on Trump's stance during a congressional hearing.
He does feel strongly that the taxes should be collected.
The only problem is there's not much the administration can do about it. Online and bricks and mortar retailers have been locked in a battle for years over whether sites like Amazon should be forced to collect state taxes. It's up to Congress to regulate interstate commerce. Representative Kristi Noem of South Dakota tried to rally support for a bill that would explicitly give states the right to require online retailers to collect those taxes. But that effort's fizzled for now. Instead, all eyes are on the Supreme Court. In just a few weeks, it's scheduled to hear a case on this very issue, with a ruling expected in June. The Trump administration weighed in supporting traditional retailers and asking for time to argue before the Supreme Court.
That's a big win for us that the Solicitor General chose to get involved in this case. We're cautiously optimistic.
Amazon does collect state sales tax, but many of the third-party merchants on its site do not. and ultimately, the final decision is out of the president's hands. For Nightly Business Report, I'm Ilan Mui in Washington.
It is time to take a look at some of today's upgrades and downgrades. Starbucks is being downgraded at Wedbush Securities to neutral from outperform. The firm sees the company's sales growth coming in below expectations, particularly its targets in China. The price target is $56. Today, Starbucks was off a penny to $57.89. Barclays has initiated coverage of Boeing as overweight, with the firm saying it sees the company's margins are poised to continue to expand. The price target was set at $388 a share. The shares closed at $327.88, up 2.5%. Bill?
Well, Sue, Goldman Sachs upgraded Exelon to neutral from sell. Goldman citing a better valuation for the energy company, along with not many negative short-term catalysts. Price target was raised $3 to $43 a share. Exelon finished at $39.01 today, up more than 1%. And following last night's poor earnings report, Bank of America downgraded GameStop today to underperform from neutral. B of A says that the company's earnings report showed that it is facing multiple structural headwinds that will continue to hit their bottom line. Price target was cut from 19 down to 11. Today, GameStop closed at $12.62. That was down 11%.
China is warning the U.S. not to open what it calls a Pandora's box by triggering a chain reaction of protectionist practices around the world. It also warned that if trade tensions continue to escalate, China could slap tariffs on some U.S. imports. But the tough talk wasn't limited to just China's side. Eunice Yoon sat down with the U.S. ambassador today in Beijing.
The U.S. ambassador maintained the Trump administration's tough line towards China. Earlier today, Ambassador Terry Branstad outlined to me some of the areas which he believed China needed to address and that are part of the ongoing discussions with the Chinese.
They need to reduce pollution here, replace coal with liquid natural gas. We have an abundance of that. That's an area. Insurance and financial services, cloud computing. There's many areas where I think there's opportunity to correct some of the unfairness in the trade situation and open up new opportunities.
He also commented on reports that the U.S. Treasury was considering using national security laws to block Chinese companies from investing in American high tech and suggested that it could be an option.
Obviously, China protects its national defense, and they have a much stricter restrictions on who can invest here. And I think we have to also make sure that our national defense and our technology advantages are not stolen. And that's what the administration is looking at, to make sure that we are protecting America's interests in the technologies of the future.
Today, the Chinese attacked what they described as the U.S.'s own malicious practices. The Commerce Ministry said the U.S. was in danger of opening up a Pandora's box and, quote, triggering a chain reaction that will spread the virus of trade protectionism across the globe. Despite the war of words, the ambassador said the U.S. wanted to continue to build the relationship with China on trade and other issues like North Korea. He said he was encouraged by the recent visit here of North Korean leader Kim Jong-un.
I think the conversations and the communications between the President Xi and President Trump have been really good. And I think the fact that Kim Jong-un is now interested and willing to meet with these other leaders, and that's an encouraging sign, and let's hope it leads to a safer and more peaceful world.
North Korea's Kim Jong-un will hold a summit with South Korea's President Moon Jae-in on April 27th. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Coming up, the switch to watching streaming video is starting to take a toll on traditional television advertising. We'll tell you how much and how big the shift is.
Barclays will pay $2 billion to settle an investigation into the bank's role in the financial crisis. The penalty settles a lawsuit alleging Barclays misled investors over the quality of the mortgages it sold. Barclays CEO called it a, quote, fair and proportionate settlement, end quote. But the Department of Justice was originally looking for a fine of $5 billion.
Spending on television ads fell last year for the first time since 2009, which I will point out we were in recession at that time. A little more than $1 billion were spent on TV advertising in 2017. That, according to research firm eMarketer. And the trend of falling dollars is expected to continue at least for the next 2 years. The shift to cord cutting and streaming video were the main reasons for that decline.
And Bill, more and more of us are cutting the cord. Steve Leisman decided to take a look at just how many are making that switch.
I stream, you stream, we all appear to stream. The CNBC All-America Economic Survey finds that 57% of Americans subscribe to one or more streaming service. That's compared with 43% who do not. And that means that this relatively new technology or media has gone from 0 to just about 60, almost at the speed of light. Among those who have both, which remote button is pushed the most, the one for cable or the one for streaming? Turns out it's pretty well balanced, for now at least, with a slight edge toward those watching cable more than streaming, as opposed to those who prefer streaming over cable. And just about a third of the public say they watch both equally. The data comes at a time of nervousness at the biggest media and cable providers over the streaming competition. The survey of 800 Americans nationwide finds some are even out there cutting the cord of their cable or satellite provider. 36% have both, and 30% have only cable or satellite, but 20% of Americans are streamers only. And what are they watching? Well, no surprise here. Among those Americans with a streaming service, 51% have Netflix, 33% have Amazon Prime, followed by Hulu. That is, the Netflix share was greater than its two main competitors combined. But all is not lost for the competition. About a third of the American public say they have 2 streaming services or more. They are, we all are, living the American stream. For Nightly Business Report, I'm Steve Leisman.
Oh, Steve. Constellation Brands raises a glass to rising beer sales, and that's where we begin tonight's market focus. Customers purchased more Corona beer and premium wine this quarter, helping to push revenues and profits above expectations. The company also said that it would invest nearly $1 billion in its Mexican operations to keep up with demand. Constellation also increased its quarterly dividend to 74 cents a share, and shares rose by 3% to $227.92. Meantime, strong international growth helped Movado post earnings and sales that easily topped expectations. The watchmaker also raised its quarterly dividend to 20 cents a share. Movado shares jumped by 15% to $38.40.
The proposed $2 billion merger between Energizer and Spectrum Brands has been approved by the FTC. We recently told you that Energizer was interested in such a deal so that it could expand its presence and grow its product lineup. Energizer shares rose 12% to $59.58. Shares of Spectrum Brands popped 15% to $103.70. Microsoft is making a bigger push into the cloud. The tech giant said it's planning a large-scale reorganization that will result in one unit that focuses on software and hardware for enterprises and another division that incorporates the Windows platform into cloud operations. The move places less emphasis on the company's flagship Windows operating system, and it highlights Microsoft's commitment to grow its cloud and AI business. The shares rose 2% to $91.27.
Time now to talk to our market monitor, who has names of stocks that he likes heading into the second quarter and beyond. And this is his first time on the program. We welcome Kyle Brownlee, who's CEO of Weimer Brownlee. Kyle, good to see you. Thanks for joining us tonight.
Thank you so much for having me, Bill.
Let's jump into your picks here. You like Travelers. We talked earlier with money manager Nancy Tengler. She likes the dividend payers. This is why you like Travelers as well, right?
It really is. You know, I think that with the recent pullback of Travelers and the stock price and the really cash-heavy position that they have and the current dividend yield, it's certainly a good place to be during this volatile period.
Let's move on to Paycom, which, you know, I was really shocked at this one statistic. You like it for many reasons, but they have a client retention rate of just under 100%. That's exceptional.
Yes, Sue, that's an amazing statistic. And I think anytime you have 91% client retention, that absolutely speaks to the quality of your tool, your product, and the team behind it. Paycom is a great kind of mid-market HR space play. They have great growth, and they do it without taking on a lot of debt. I really do like Paycom.
Okay, and number 3 for us tonight is Raytheon. Why that one?
You know, Raytheon right now, I think is two things. One, again, the dividend and the cash position. They've recently been awarded some large government contracts, and I'm really bullish on just the defense sector right now, especially with the current administration and kind of the way the world is moving. I think all 3 of those are good positions, but Raytheon primarily for defense, secondarily for the dividend pay as well.
You know, we hear a lot about the overall market with valuations being a little rich in certain sectors. You gave us these 3 names, but are you finding other opportunities in the market? How do you view it overall?
Yeah, I really am. I think as volatility increases, you know, volatility creates opportunities for investors. And so it also creates the need to be more diligent in the research and the reviews that we perform. So I see it as volatility continues in this next quarter, as I expect, Q2, we're going to see more opportunity, but they may be harder to find, which just means we have to work a little harder to come up with good advice.
And there is every expectation that the Fed is going to continue raising rates, maybe as many as 3 more times this year. Do you see that with these dividend payers that you like as a threat to them, or does it make them more attractive to you?
Yeah, great question. In my opinion, I really see it as an advantage to these dividend payers. Assuming that we see the Fed continue to raise in Q2, I very much expect investors are going to be looking for an alternative position to bonds for income and risk mitigation. Those high quality, large cash holding, dividend paying equities would be a great place to be, so they very well may benefit from that Fed move.
Kyle, good job. Thank you. Hope to see you again soon.
Thank you. Appreciate it, guys. Thank you.
Kyle Brownlee with Weimer Brownlee, and to read more about Kyle's picks, you can head to our website at nbr.com.
Coming up, it's time to play ball for big bucks.
I'm Eric Chummy at opening day. The business of baseball is bigger than ever. We break it down coming up next on Nightly Business Report.
It may be March 29th on the calendar, but spring is in full bloom on the diamond because, believe it or not, it is opening day for Major League Baseball, a time of optimism not just for the 30 teams, but for the $10 billion business of professional baseball. Eric Chummy takes a swing at the story from one of the home fields of the Mets. It's Citi Field in New York.
It's opening day in America as another season of baseball begins. For fans, this is the most hopeful time of year, as every team is still undefeated and many can consider themselves World Series contenders.
Dude, my heart's jumping out of my chest. I can't even explain it. Jeez, we're going to opening day.
This is my 3rd year in a row going to Mets opening day, so I'm thrilled to be here.
Oh, my first opening day. Fan since the 70s.
2018 World Series champs.
That optimism is also true at MLB headquarters. The commissioner and his staff are looking at 2018 to continue the momentum they've built over the last couple seasons, when World Series TV ratings had been the best of the entire decade. Baseball now has record revenues over $10 billion, new sponsorship deals, and a new streaming deal with Facebook. That makes Major League Baseball the first of the big 4 U.S. sports leagues to grant an exclusive digital rights package for regular season games. Yet it's not all home runs for the league. League-wide attendance has dropped 4 of the last 5 years. Local TV ratings were down in almost half of the clubs, and Major League Baseball's advanced media division recently laid off 50 employees as part of a broader reorganization.
Baseball is really going through sort of a reimagining of things and updating itself for the 21st century in a pretty impressive way. It should see sunnier times ahead for sure for the league, for the franchise, and for the players. But it's going to take some time as things sort of flesh themselves out.
Part of the attendance and ratings declines are because some teams are embracing the rebuilding process, focusing on developing their young talent. The Royals, Cubs, and Astros all did the same thing, having several losing seasons before finally winning it all. But on opening day, every team is still tied for the best record in the league, and America's pastime is looking to grow into the future. For Nightly Business Report, I'm Eric Chemi in Queens, New York.
And apparently, Eric, was good luck for the Mets because they beat the Cardinals today in that home opener at Citi Field. Before we go, one more look at how the markets finished this last trading day of the first quarter of 2018. A strong day for the bulls. The Dow rising by 254 points, back above 24,000. Dow component Intel helped out there, rising by 5% on the day. The Nasdaq climbed by 114 in a resurgence for technology, and the S&P added 35. For the quarter, the Dow was the big loser, down more than 2%. And even with tech's recent problems, if you joined us late, that is not a misprint. The Nasdaq climbed by more than 2% today, and the S&P was down 1.2% as we head into the second quarter of the year.
It's hard to believe,
yes.
Right?
Yeah.
Wow, that'll do it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks so much for joining us.
I'm Bill Griffith. We'll see you tomorrow with a special edition of NBR. In the meantime, if we don't see you then, have a great weekend. We'll see you on Monday.